It was a solid US jobs report, and it has steadied the markets. But it caps a tumultuous week full of flashing economic warning signs and rampant volatility. So now, investors in the market are hoping the negative headlines might push the Fed to cut interest rates once again. Well, today's numbers leave you a bit of a mixed message. 136,000 jobs added in September, less than expected, less than the consensus. But the unemployment rate is down to 3.5%, the lowest in 50 years. However, wages are not growing. They were unchanged, the average hourly rate. And negative data has inflamed fears of US slowdown. Let's remind ourselves how the week has gone and the bigger picture. On Tuesday, we saw the clearest sign yet. Manufacturing's been slammed by the trade war with China. The sector is in contraction, and it hasn't been this sluggish since the Great Recession. On Thursday, data showed US services sector, jobs in banks, restaurants, hotels and the like, also slowed to the lowest level in 3 years. Even though the unemployment rate's strong, job growth is clearly slowing. And this week, President Trump blamed the Fed for the weak numbers. As I predicted, Jay Powell and the Federal Reserve have allowed the dollar to get so strong, especially relative to all other currencies, that our manufacturers are being negatively affected. Fed rate too high. They are their own worst enemies. They don't have a clue. Pathetic. Which I think is somewhat strong language about the good burgers at the Federal Reserve. Economists says the president's own trade policies that are causing these warning signs to flash. So let's go straight away to the White House's foremost advocate for US tariffs on China and the trade policy. It's Peter Navarro, who is at the White House. Peter, good to see you on this Friday. Thank you, sir, as always, for giving us time.
Good evening to you, sir, across the pond.
Good evening. Now, let's begin. This trade number, I'll grant you, the number is good, the economy is strong, and the US economy is by far and away the best performing at the moment. But there are warning signs within this trade number that the administration needs to take care of. And it's not just the fact that unemployment's down at 3.5%. Do you accept that?
No. Let's look first at the numbers today. I think one of the reasons why the market was so bullish today is if you parse through the numbers, you start with the top line, 136,000 new jobs, but we also had, Richard, 45,000 jobs upward revisions over the last 2 months. And if you work that in with the wage data and the productivity data, what that does is allow you to forecast a GDP growth rate in the range of 2.5% to 3%, which is robust. I mean, that is bullish. The manufacturing issue, I looked at the ISM manufacturing index. It's one of my favorites. It's definitely below 50. But there's a new kid on the block. It's this PMI that Markey does, spelled with an IT. And that one's above 50. And the difference between those two indicators, Richard, is the old one, the ISM, basically is export dependent, whereas as the market one is more domestic manufacturing. So I think this is a great number. I can see why the market's excited about a 2.5% to 3% growth rate, but the Fed. We'll talk about the Fed.
So let me come to that. Aren't you on a difficult position here? Because you've just told me how great everything is. You've told me how we can extrapolate growth numbers which are acceptable. Well, I'm sorry, Peter, but you can't have your cake. You can't have your Fed cake and eat it.
See that place behind me, the White House? What we do here at the White House, what the president does is great, right? We're not satisfied for good or very good. And the problem with the Federal Reserve policy is that it's inflated the dollar. It started inflating overvaluing the dollar by raising rates too far and too fast. That was a Jay Powell thing. We call him the caterpillar killer around here. Caterpillar tractor trying to sell their exports, right? And now what's happening in the chess game of central banks, the European Central Bank has really outmaneuvered Jay Powell because it's been lowering faster than we are. So you get these big spreads between the U.S. and Europe. You get a carry trade going, and we see in the data that our exports are being heavily hit. The straw man is this trade tension stuff. The reality is it's the overvalued dollar. Jay Powell, the caterpillar killer.
So let's accept that you wish to abandon the old rubric that a strong dollar is in the best interests of the United States. That's the
Not
line.
a strong
Well,
dollar. We love a strong dollar. It's
Right.
an overvalued dollar. If we had a strong dollar prior to Jay Powell raising rates too far and too fast, and that basically put our strong dollar on steer.
But hang on, Peter.
Not good for
Hang on.
exports.
I mean, let's look at the dollar. Let's look at the president and the dollar. In 2017, the president said that the dollar he routinely said the dollar was getting too strong. That was in 2017. A year later, and the president reverses course. In 2018, he said he wants the dollar to get stronger and stronger. Have a listen. Back in you in a minute.
I'll tell you where I stand, which ultimately is very important. Number one, I don't like talking about it because, frankly, nobody should be talking about it. It should be what it is. It should also be based on the strength of the country. We are doing so well. Our country is becoming so economically strong again, and strong in other ways too, by the way, that the dollar is going to get stronger and stronger. And ultimately, I want to see a strong dollar.
Last August,
I agree with that.
Hang on.
I totally agree with that statement, Richard. We want a strong dollar, but we want a strong dollar because of the strength of our economy, not because the Federal Reserve raised rates too far and too fast, and the European Central Bank outflanked Jay Powell by lowering their rates faster than we're lowering ours now.
But
You believe, you take my point here.
I do.
The higher the dollar goes, the lower our exports go. Do we agree on that?
The technical factors are unimpeachable, if I can use that word.
No, you can't. That's a process foul.
But you know what I mean. But the reality, Peter, is that that you are asking to use interest rates as a mechanism for shifting the exchange rate. It's a classic beggar thy neighbor policy.
I'm asking Jay Powell not to do that. He did it to begin with, and like inadvertently, I suppose. He didn't know what he was doing. Look, if you don't think Europe has been engaged in that kind of competitive evaluation at the European Central Bank, I've got a bridge to sell you up there in New York.
But the difference, of course, though, is the reason, and I sound like I'm doing your job for you here, but the reason the dollar is strong is because your trade policies have created a safe haven environment that investment is flowing into this country.
And that's the consistent part with the clip you played from my president, right? We are strong here with our economy. That's why the market is up today. But we don't want to have a dollar on steroids. So part of that certainly is investments coming here and pushing up the dollar because people want to be here. But listen, part of it's the carry trade and part of it's that big spread. I mean, if you're a speculator and you can make a buck on a 200 basis point spread between our rates and Europe's, you're going to do that. What does that do? It wreaks havoc with the dollar. It's the caterpillar killer. So,
right, so
here's what I would ask, Richard. It's like I listen to financial shows all day long, and all I talk about is trade tensions. And there doesn't seem to be any recognition that the more fundamental problem is this imbalance in the exchange rates. And I don't understand how sophisticated people. You get it, but you get it. But most of these people in the financial networks, they don't even think about it.
You surely, if you do lower the exchange rate, if you lower the interest rate for the specific purpose of weakening the dollar to aid exporters, that is a beggar thy neighbor policy. And
I agree with that.
And arguably,
that.
That's not what the Europeans did. If I look at the euro dollar...
No. Let's be clear. Like you had, I think you had 39 countries around the world cutting their interest rates in that kind of competitive devaluation competition. Here's all I'm asking for is it's a chess game, Richard.
Right.
It's like when the Fed sees the European Central Bank make a move, say lower interest rates, they've got to make the decision whether to match that move or not. If they don't match the move, that means our exports are going down and our growth's going down. Our prices will go down too, that's the benefit. But in that chess game over the last year and a half, Jay Powell's been playing checkers in the chess world, and that's the problem.
Last chance for trade on China. Before we say goodbye to you for the weekend, where would you say you are at the moment? There are more talks to be taken place. The whole thing has now got enmeshed in the question of whether there was a quid pro quo. We don't need to go into that discussion of phone calls there. I'm just interested in your view on whether or not we are more or less likely on a trade deal.
I think we'll have a good week next week. The deputy level negotiators are coming in from China on Monday and Tuesday, and then the big show begins on Thursday and Friday with Ambassador Robert Lighthizer sitting across from Liu He. As I've said many times, we like to negotiate behind closed doors. So let's see what happens. We're either going to get a great deal or not, according to the president.